Hello, everyone, and welcome to another market update. What is today? The 5th of August. It's Friday. Happy Friday. Hope you have all had a fantastic week. Checking that the sound is on. Believe it or not, I have recorded whole videos with my sound off and had to do it again. So I always, when I'm looking down, I'm checking to make sure my mic is on. Anyway, let's get into the top three things today. There's a lot to talk about, and a lot has actually sort of begun to change in the market place and in the complexion of what's going on in the marketplace. I want to touch on those things because we're now absolutely into a bear market, but we're getting a nice bounce. So first of all, item number one is recession risk. I actually think we're already in a recession, but I'm just going to touch on that. Number two will be what central bankers are doing right now with interest rates and excuses and things that they're not excuses per se, but the things they're talking about with regards to rates and what the bond market is signaling, because as I've been saying consistently over the last number of months and probably the last few years, is that the bond market, it sets longer-term interest rates. The Fed sets short-term interest rates. And then I want to talk about the earnings season that we're in currently. We've had almost, I think, 400 of the S&P 500 companies reporting, and I just want to give you some color on that. So I've got a chart up here on the screen of the CRB index. This is the commodities index, which I'll come back to in a moment. But we have had 2 quarters of negative GDP growth. And interestingly enough, President Biden has come out and said, no, we don't have a recession. Now, I think this is astounding that these people in the White House and in the liberal media are now trying to tell us a story that we are not in a recessionary environment. Growth is slowing. We have 4 quad 4s in a row coming our way. This is in the US, and 3 quad 4s coming our way here in Australia. This is not good. The economy is slowing down. And so I think we're probably already in a recession now. We won't have that confirmed until after we have more cycle time, because you only can really confirm a recession on a look back. But certainly the effects can be felt immediately in terms of reduced consumer spending, business conditions deteriorating, consumer confidence deteriorating. A lot of metrics can actually confirm that you're in a recession. One of the key metrics, I'm just going to see if I have it here. Yeah, and I've shown you this chart before. One of the key metrics to confirm recessionary environments is the yield curve spread between the 10-year and the 2-year. And right now, sorry, just to explain the curve and this metric that you see here, the 2-10 spread is currently inverted. What does that mean? That means that the 2-year rate is higher than the 10-year rate. If you can, believe this, it's true. So I'm not telling you any lies here. The 2-year rate is currently at 3.1% or thereabouts. It's right around 3.1. At least it closed at that yesterday. The 10-year rate closed at 2.74. So it is more advantageous for an investor to invest in 2-year treasuries yielding 3.1% currently than to buy 10 years at 274 or even 30 years at 2.97%, which is what is currently happening in the U.S. Treasury marketplace. And whenever the yield curve inverts, it has 100% of the time caused a recession or is presaged a recession, because the bond market, as I was explaining in my little intro, the bond market dictates interest rates and discounts future economic events. And so again, what the bond market is effectively saying here is we believe that a recession is going to occur, which is why the longer end of the curve has been coming down. And remember what I said, or have been saying consistently, is that the central banks, U.S. Fed, RBA, they influence the shorter term money, so the short end of the yield curve. And they're able to do that. And they're going to continue, by the sounds of it, the Fed and the RBA. And so I'll just jump into point number 2, which is central banks. They're going to continue, or they're signaling that they're going to continue raising interest rates. Now, this is lunacy that they are going to do this, because to fight inflation that they caused, by the way, through all of their very loose and lax monetary policy over the last couple of years. So they are putting out a fire that they started, if you want to look at it that way. But they are continuing to signal they're going to be raising interest rates. Just going to see if I've got I thought I had a chart. Well, there's the 2-year Treasury yield going straight up. Sorry, I thought I might have had, that's earnings. We're going to come back to that. That's the quads. We're going to come back to that. Maybe I don't have a chart up of this. But in any case, they are raising rates into an economic slowdown. This CRB chart, one of the reasons I've got this up here is so the Commodity Research Bureau, the commodities basket, it shows you very clearly that we are now in a deflationary environment or a disinflationary environment because of the fact that the CRB index continues to fall, and precipitously, by the way. And just as a reminder, in Quad 4, commodities, you don't want to own any sort of commodity because they all go down, predominantly because the US dollar is very strong in Quad 4, which it currently is against all the major currencies. It's had a stellar run this year against all major currencies. So you wouldn't want to own anything like corn, soybeans, wheat, just about any commodity, even oil now. I don't know if I've got an oil chart here. I thought I did just a moment ago, pass over that. Maybe I didn't, but oil, oh, there we go, I do. But even oil has literally crashed. I mean, it's up here at, topping, cycle peaking around early June, around 122-ish a barrel, and it's now, this is USD, of course, a barrel, and is now down around the $90 a barrel range. I think it closed yesterday around, 90.66, and continuing to move lower. One of the main reasons for that is, of course, as commodities and oil was a big driver of the inflation that we've seen out there, but as the oil price ramped up, we saw demand destruction, people not being able to afford to put petrol in their cars, not being able to spend money in other parts of the economy because it's costing them more money to put petrol in their cars. And even with this adjustment in petrol prices, we haven't really at the pump here in Australia seen too massive of an adjustment because, of course, the Aussie dollar has been falling. So even though oil's been falling per barrel in price, the Aussie dollar has continued to fall, which has sort of negated, I suppose, to some degree, the actual fall in crude prices. At some point, obviously, that will probably adjust further, and as oil prices are likely to continue to fall. Now, I think the oil companies have had one of the absolute most stellar quarters that they've had in the last number of years. And that's all off the back of this oil price ramping up to that high of around 122 a barrel. Anyway, the point is that inflation is already coming out of the system because of things like crude oil dropping. It's a big component of the CPI, by the way, and of course other commodities. I mean, there's cheese and lumber. Who tracks that, right? I suppose lumber maybe, but not so much cheese. But just massive drops in this stuff. But again, the CRB index falling precipitously and likely to continue to fall. So again, just to lock off this point about central banks and what they're doing to the interest rate complex over the last, I'd say, 3 to 4 weeks, almost every single week, we've received emails because, as all of you know, I'm sure, we do mortgages. Interest rates continue to rise. This is going to be a real problem at some point for a number of people. One of the key metrics coming up in terms of interest rates is that, that really cheap fixed rate money that people were getting, 2 years ago during the COVID crisis, and you could lock in a 3-year fixed rate for like 2% and all this sort of stuff. Well, guess what's going to happen over the course of the next probably 12 to 18 months? All of those interest rates are going to start resetting, and those people who had a fixed rate at, say, 2% are now suddenly going to find themselves at a variable rate of probably in the realm of the mid to high 3s to potentially low 4% range. That is going to be a big shock and a big adjustment to family budgets. And of course, what that's going to further cause is a contraction or a constriction in disposable income, or how much disposable income people have to spend on stuff, and they're going to have to. The average consumer, I dare say, is going to have to prioritize now their mortgage and the necessities of life for expenditure because their cash flows are going to be deeply impacted by mortgage resets, for starters. And one of the other issues, of course, too, with the elevated commodity prices that we've seen over the last probably year is that a lot of companies have had to absorb some of those cost increases in their own profit margins, which ultimately affects their earnings per share, their ability to earn. And so point number 3 today was earnings, and I just wanted to show you this current table. So, 339, sorry, I thought it was 399. So about 340 companies thus far. This is as of the 3rd of this month. Let me just see if I've got an update on that in here. On earnings, here we go. Okay, so we're up to 377 now. And come on, why is this not? There we go. It's not behaving. As I mentioned a moment ago, the energy sector, 20 of the 23 companies reported. Look at this, earnings growth in that sector was 342%. Now, we're not going to see a print like that going forward. The next print we're going to see from them might be positive, still because oil is slightly elevated. But as we go further into the back half of this year and early 2023, even the energy complex and energy companies are going to start to sell off because their earnings are not going to be as good. And certainly, a sales growth figure of 75% is pretty unprecedented as well as a metric. But look at these other sectors where we're seeing marked poor earnings growth. So even something like consumer staples, which typically do well in a recessionary environment, have only had 1.9% earnings growth. And if you stripped out, I suppose, or adjusted for a likely earnings growth rate in energy of something much, much lower, all of a sudden we're looking at, for the entire S&P 500, probably a negative earnings growth. But some key sectors to just highlight here, the consumer discretionary sector, where I guess 2/3 or so of the companies have reported very, very poor earnings growth, negative 3.3% there. And financials have just gotten absolutely hammered. So these are banks and credit card companies and other insurance companies and stuff. With interest rates rising, that's bad for a lot of banks because it constricts their margins, and they have to readjust for tighter margins. It also causes more delinquencies and more missed payments and late payments. So, I'm sure you know this, but banks and credit card companies and anyone that's in the business of lending money, their main source of income, as in their main source of income on their P&Ls, is interest income. And if margins are being compressed in the banking sector, it flows through to their earnings. And that's a pretty big sector in most economies outside of consumer spending. Financials are one of the next largest sectors. So that does not bode well for going forward. And sales growth, as you can see here, for the financial sector is pretty anemic at 0.27%. Other notable sectors that have struggled a little bit, tech. A lot of tech companies, big tech, growth-oriented tech companies, have seen huge drops in their earnings. Google is a great example. Facebook, a great example. Netflix, another great example. These are mega cap tech companies, and their earnings are terrible. This is going to continue to get worse. So I would expect that when we come around to our next earnings cycle, these numbers are going to change. But of course, what does that mean for the individual company? So if revenue, which is really to say sales growth, is falling and declining, companies are not going to be able to pay out dividends. They're going to have poor earnings. They won't be able to spend as much on CapEx, all this sort of stuff. And that is bad for stock prices. So I guess one thing to sort of say about the environment we're in is that stocks don't go up during recessions. Stocks don't go up in a contractionary economic environment. And so it's one of the reasons why I don't own a lot of stocks, if any, right now in portfolios, or I'm in my personal accounts shorting a lot of stocks because of all of these factors that I'm discussing. So because like super accounts are long only accounts, you can't short in them. You would just go to cash and really not be long of equities. One notable exception to that would be utilities, which when you're in a recessionary environment, what you're looking for is quality cash flow from a company. And utilities tick that box because, of course, they are a fairly inelastic demand. If you're in the U.S. Or well, anyways, anywhere really, Australia in summer, and it's really hot, you want to air condition your home, so you're going to pay the energy bill. And the flip side of that, of course, if you're in a cold environment, in a winter, in a cold environment, you're going to have to pay to heat your home. So utility companies will typically be insulated from a real drop-off in earnings, and they will have quality cash flows because people are going to pay their utility bill to keep the lights on, the air conditioning on, and what have you. So the next thing I just wanted to show you, so that's kind of a wrap-up of where we are right now and what's going on in the game. And I just wanted to share with you an update. I've shown this table a few times, but I wanted to share with you an update on the quad outlook for the U.S. And it's not good. It's quite dire, actually. We're looking at 4 consecutive quad 4s in a row. And this is not good. And as we go out in time, even towards 2Q of 2023, we're getting worse and worse in terms of the quad outlook and the depth of the quad 4 that we're likely to be in as well. So there's plenty more downside and bad things to come in this market. One of the things that is driving, I suppose, this market right now, I think, is the sheer fact that so many people who are participating in the market now haven't actually experienced a proper, deep, and bad recession. And so every time, and of course there's a lot of cheerleading that goes on from the financial media. Every time we get these dips and stuff in the markets, they're going, oh, you got to buy this dip, and earnings are okay. And they're just liars. They just tell a lot of lies about what's actually really going on under the hood, because they are in the business. Many of the firms on Wall Street, and you could say on Bond Street or whatever in Australia, they're in the business of selling you stocks. That's what brokerage houses want to do. That's what the financial media wants to do, is for you to click on the clickbait, buy into the BS stories and all of that. And I'm telling you now, right now, unequivocally, this bear market's not over, and it's going to get worse. And what the next catalyst will be is I don't exactly know. It'll probably be some confirmation, from the Fed that they're going to continue on their rate rising cycle, and the penny's just going to drop in the market, and people are just going to, well, we've now got to really start discounting the effect that this is going to have. I mean, half of these people, it's probably more, that trade and do stuff on the markets, can't see past the next couple of trading days. They react to the market conditions because they have FOMO, so stuff starts going up and they think, oh, I've missed it or whatever, and they start buying stocks, and over the short term that might influence the stock market somewhat. But these rallies, and I did have a table up here that I want to share with you on volume, is that, now this volume is just short term and it's over the last couple of days. But volume over the last week of this reasonably decent rally in the stock market itself in the U.S. has been very poor. And it has not been going up on up days quite a lot. And on down days, it seems to accelerate in as well. So volume is a key measure of what is actually going on in the stock market, and volume has been pretty sort of mooted, which tells me that the market is I don't know. It's just the trading that's going on low volume and in specific names, as an example, in the market is not something to give me conviction that we're, anything is changing, like we're going to a bull market or something like that. Now, let me just do a quick run around the rain room, and I hope all of that sort of makes sense. I suppose to just summarize and give you a one-liner, if that's what you're sort of interested in on this, is that we're not out of the woods yet. We're in a recession, I think, right now, And again, stocks don't go up in recessions. I mean, they might go up over a day or two, but over the longer trend during these recessions, they're headed to the downside. Let's just do a quick run around some metrics that we usually discuss, and then I will go home for date night. So just a couple things to highlight. Volatility over the last week has come right down, and that's good, I guess, for the short term. But it's something to be very wary of, and this happens all the time, where volatility will recede. People will get enthusiastic about that. They'll start buying stocks. Allocators will start allocating more stocks because whatever they think, maybe we're going back to the investable vol bucket, which is 10 to 18, let's say. But we're still in the chop bucket. We're still at 20 plus vol, and that vol number could go quite easily back to the high 20s and possibly low 30s in a second, in a New York second. So I am not worried about the fact that vol has come out of the market. Even some of the other metrics like the VIX, the NASDAQ vol and the RVX or the Russell vol have come out of the F bucket, but they're still in the chop bucket. So again, even though the S&P 500 vol has come down a little bit, the NASDAQ and the Russell vol are still quite elevated. Oil vol has also popped a little bit here in the last week or so as the oil price continues to come down as well. So that's something to probably highlight. Gold has had a nice run. That's something to highlight and take note of as well. Gold has had a pretty good stretch here over the last week to 2 weeks of run up. So we'll see where gold ends up. If this is just a shorter term bounce in gold, because of course the gold shares an inverse correlation to the dollar. So if the dollar resumes a big up move, gold could recede a little bit from here or pull back. Pardon me, but very likely at some point the gold market, and maybe this is it. I mean, it's hard to know for sure until we get more clock time on the chart here, but it could be that gold has sniffed out the fact that the Fed's going to have to start cutting interest rates at some point, and of course then the dollar falls and interest rates falling and gold will get a fantastic bid. So we'll have to see how that goes. What else do I need to share with you? I think that's probably about it. Volatility usually being the biggie for us to watch. So yeah, I think I'll leave it there. Again, key themes to just continue ruminating on if you are concerned about what's going on around the world in marketplaces. Just know that the macroeconomic environment is really bad, or let's just say bad. There's no really, you don't even need to qualify that. Qualify bad as bad. It's bad and it's getting worse. So we're not out of the woods yet, and the bond market actually to that point has started to, at the longer end of the curve, we're starting to see some bids, I suppose, for those longer term securities. So what that means is people are now allocating more capital into the bond market and sniffing out that we're going to have some real problems with the equity market. So again, not out of the woods yet, and more to come. When that happens, don't know, but I suspect we are, as we enter the middle of the month here in August, we'll start to see potentially some more volatility creeping in and some more downside. So with that, I will say have a fantastic weekend. Always a pleasure to deliver you these market updates. I hope they are making sense, and please, if you are watching them consistently, that's fantastic. If you are not watching them consistently, I would urge you to do that, because you will pick up stuff that I talk about in them that'll be useful potentially in your businesses or elsewhere in your lives. So have a great weekend, and I'll talk to you next week. Bye-bye.